All right, hello everybody. My name is Mark. I'm the stock market jobber, and I am a former institutional trader who was brought into the industry by the great Mario Gabelli. I traded directly for him. I also traded directly for Steve Cohen. I was a market maker, and I was the head of trading at three different institutional money managers. So when it comes to trading, I've been around the block a lot, and now I want to teach people like yourselves. So let me just start with this chart of cues here because it gives a lot of lessons. Now, there's a lot of mythology out there, well, especially when it comes to terms of technical analysis and what goes on Wall Street. Things like Elliott wave and Gann theory and Fibonacci are basically, in my opinion, science fiction. All right. Institutional traders do not pay attention to stuff like that. What we do pay attention to is what levels are important, what's the trend, and what's the momentum. Now, let's just take a look here at Qs. We can see some different things going on here. Price levels. Some price levels are more important than others. Notice how we ran into resistance there. Then 5 months later, we hit resistance at the same level. When a market's going higher, there's not enough supply or sell orders to fill all of the demand. So the buyers are forced to pay higher prices. They're forced to pay a premium. When we get to a resistance level, well, all of a sudden there is enough supply to fill all the demand. A lot of times when we get to resistance, we get a reversal, like here or like here. This is because some of the investors who created the resistance with their sell orders start to sense that there are other sellers around. That's why the market's not moving higher anymore. And they start to worry that they're going to miss being able to sell. So they start to reduce their prices and they start undercutting each other, and it results in a snowball effect. The same thing happens when we get to support. If we're going lower, it's because there's not enough demand or buy orders to absorb all of the supply or sell orders, and the sellers are forced to offer their shares out at a discount, and that forces a downtrend. When we get to a support level, it's the opposite. There's enough demand to absorb all of the supply. And notice how this level is important, right? It stayed intact, or it was support from October through January. This level was resistance. When a level retains its importance, we call this market memory. And sometimes these levels can retain their importance for months, sometimes even for years. Now, what else do we see here? Here's another important level, right up around here. Notice how what was resistance converted into support. Now, why would this happen? Well, this happens because we have seller's remorse. There's investors here who sold and they regret doing so when the price moves higher, so they tell themselves they're going to buy their shares back, but only if they can get them for the same price they sold them at. So we have remorseful sellers placing buy orders at the level that was previously resistance. And if there's enough, the level converts to support. You can even see it over here. Resistance became support, support. What else do we see on this chart here? Notice where the close was. 300. I mean, 299.68, but that's pretty much right at 300. People like nice round levels. So this is a psychological level. People say, oh, if it gets to 300, I'll sell it. People don't say if it gets to 299, I'll sell it, right? Now, what else do we see here? Trends. Markets are always trending. They're always going up, down, or sideways. So how can we tell when a trend is changing? Well, one simple way is just to use their basic trend lines. It takes a little bit of practice, but it'll be well worth it. See, we're in the uptrend. A trend line is like a graphical illustration. It's not like a support resistance level. It's just something to help you see things more clearly. Because the way a chart is constructed, if we before we start going down, after going up, well, we got to stop going up. Right? Before a market can go down, it's got to stop going up. So the way charts are written, if the price starts to go sideways, we just happen to cross the line. Same thing here, downtrend. All right, so it takes a little bit of practice, but it's not. It's well worth it. Now, what else do we see here? Well, there's a principle in markets that when a market is overbought, which means it's trading above what would be its typical trading range, we call that overbought. This indicator down here is a simple indicator to measure momentum. Overbought and oversold are terms that refer to momentum. So overbought stocks, or in this case an ETF, that get to resistance tend to sell off. oversold ETFs or stocks or whatever financial market they get to support tend to rally. So we can see down here we're oversold. We see up here we're overbought. We get to resistance and we reverse. We get to support and reverse. And we get to resistance and we reverse. So that's it. If you want to really learn how the markets how the markets work, you got to pay attention to these things. What are the price levels that are important? What's the trend and what's the momentum? And that's it. Please make sure you sign up for our YouTube page here, and I will see you soon. Thank you, everybody. Have a good day.